Greetings, members one and all of the Salivation Nation. The monetary logic for gold and silver. Let's explore. Yes, I think sometimes it's good to be reminded about the monetary aspect and qualities of gold and silver, especially in this day and age. I'm going to be referencing an article from Seeking Alpha by Gold Money. I think it's fairly well written and kind of puts everything in perspective given where we are at and with current events. So we'll go through here. A considered reflection of current events leads only to one conclusion, and that is an accelerating inflation of the dollar's money supply is firmly on the path to destroying the dollar's purchasing power completely. Now, that is a statement that I believe is true. We are on this path to be able to destroy the purchasing power of the dollar completely. In fact, if we look at the dollar's value, where it is now compared to where it was in 1913, in December of that year, which started the Federal Reserve Act, one could certainly make the conclusion that if you told them this back then, where the dollar's purchasing power is today, they would laugh in your face. But it is true. How many dollars will it take to buy a loaf of bread 20 years from now? So this is going to look at the theoretical and empirical evidence from previous fiat money collapses in order to impart the knowledge necessary for individuals to seek early protection from an annihilation of fiat currencies. It assesses the likely speed of the collapse of fiat money and debates the future of money in a post-fiat world, in which the likely successors are metallic money, gold and silver, and some would even say cryptocurrencies as well. We've seen Bitcoin take a pretty big jump and leap as of late. Is starting to really make a mark on the monetary space. Early action to lessen the impact of a failure of the fiat regime requires an understanding of the role of money in order to decide what will be the future money when fiat dies. Will we be pricing goods and services in gold or cryptocurrencies? Will gold be priced in Bitcoin or Bitcoin priced in gold? And if Bitcoin is priced in gold, will its function as a store of value still exist? Those are some of the questions you can ponder as we take and consider where fiat currencies are these days. It is something else to see where how much the dollar has lost value over the course of time. This dollar that you see before you here, it's even by the time it was issued into circulation sometime after 2017, it has lost, by the standards set to us by the Federal Reserve, at least 2% per year. And more so, they are sliding inflation to go up to 2.5+%. This week, we saw the news of a vaccine that had been found to combat the coronavirus. In fact, two competing companies are saying now that the vaccine will be almost 95% effective. It offers a prospect of humanity ridding itself of the virus in due course, but will not be enough to rescue the global economy from its deeper problems. Monetary inflation is therefore far from running its course. In fact, as I've talked about in previous videos, we have seen the Federal Reserve enact quantitative easing policies and repurchase agreements by lending money to in between banks to keep the interest rates low. It's $700 billion, one fell swoop, literally within the course of a day or two. It's crazy. So to get a grasp of what's truly happening in capital markets, it's usually best to stand back and observe the broader context. If you look at it, between three major indicators this year, the S&P 500 index as proxy for the stock market, and the copper price as a proxy for industrial commodities, and gold as a proxy for monetary inflation. We take a look at all of those and how far they have gone up. Gold and copper really tend to be kind of in a world where they're kind of conflating, coming together, and the rise. And gold has been kind of been low since about March of 2020. The stock market has slumped along with copper and gold have broadly flatlined. The signal suggested that stock markets and commodity prices were discounting an economic slump and that the gold perhaps offered a haven from systemic risk, at least until it fell sharply in late March. On the 16th of March, the Federal Reserve Board cut its funds rates to zero effectively. The following Monday, the Fed declared unlimited quantitative easing to support the economy through what it had declared would be a V-shaped recovery. In other words, an injection of money was expected to ensure economic recovery and a return to normality. March was also the month many countries entered lockdowns to combat the first wave of viral infections. So following this announcement, stock market recovered sharply, being the direct beneficiaries of a limited monetary expansion, which we discussed later. Copper recovered strongly and was said to be on an improved prospects for a global economy. But the backstory here is more concerning. Following the Fed statement, China's government decided to reduce the stockpile of dollars by buying key industrial commodities, particularly copper. Widely adopted by other foreigners and subsequently the American public, it is a policy that will ultimately destroy the dollar's purchasing power. And so that is an interesting thing to take into note and consideration. The threat of infinite money printing to the purchasing power of the dollar drove the gold price to new highs, but it can be seen that gold generally underperformed equities and copper by a significant margin if you look at it on a chart. In one sentence, the reason is the establishment's dislike and suppression of gold as a rival to fiat currencies, and ignorance in the financial community about the effects and consequences of monetary inflation. So if we look at the pre-dawn of history, with the limitations of barter became an impediment to further human progress, two conditions needed to be satisfied. A form of intermediary good commodity commonly accepted as a medium of exchange was indispensable, so that through the division of labor and by their individual skills and knowledge, humans could maximize their output in order to acquire other goods to satisfy the needs and wants. The classical economists define the division of labor and with the role of money as Say's law, after the French economist Jean-Baptiste Say, who described it. The economic benefits of the division of labor are now taken for granted, even by socialists who are otherwise scathing of free markets. And the intermediary good, money, evolved to become commonly accepted by diverse communities, even those who did not trade with each other. Eventually, all civilizations accepted metallic money as a durable, reliable, and quantifiable units of exchange. So in descending order of value, that which we would term their purchasing power today, metallic monies were gold, silver, and copper. Before the dawn of history, when scribes began to document events, metallic money had already become established. History then recorded numerous occasions when the powerful deceived the public by corrupting money, obtaining it for themselves while forcing the public to accept inferior or worthless substitutes. The Emperor Nero famously debased the Roman denarius to pay his troops, an act necessary for his personal survival, and a policy pursued by his successors for 2 centuries. In China, Kublai Khan confiscated gold, silver, and precious stones, doling out paper substitutes made from mulberry leaves. China was the first nation and empire to use paper currency. From ancient times to present day, kings, emperors, and now governments, more often than not, were and still are heavily indebted to and authorized schemes to replace gold and silver with debased coinage or their own alternative forms of money. The public's choice of a medium of exchange was incorruptible. A ruler's choice was made with the intention to debase as a source of finance. Gold and silver had long been accepted as a medium of exchange, chosen by those that use it. The fact that its quantity could be expanded by government was no impediment to the advancement of national and personal wealth. The improvement of living standards throughout Europe and America to the 19th century was a testament to the combination of free markets and sound money. The limitations imposed by metallic money on the state's ambitions were seen as a hindrance by socializing governments. The modern template of a resolution of the problem was the Prussian-led Federation of German States, unified in 1871 by Otto von Bismarck. According to George Knapp, promoted his state theory of money in 1905, Bismarck furthered his statist ambitions by seizing the opportunity given by Knapp's state theory of money to finance the expansion of Germany's military forces, issuing marks unbacked by gold while still on a gold standard. In August of 1914, Germany's gold exchange standard was temporarily abandoned. And when it became clear that the war was not going to be the short conflict which Germany expected to win, the purchasing power of the paper mark began to fall, collapsing to a national trillion paper marks to one gold mark in November of 1923. Other European currencies without a gold exchange standard and those who put vast quantities of unbacked money into circulation also suffered monetary collapses, notably those of Austria, Hungary, Poland, and Russia. Bismarck showed in the years before the First World War that the gold standard was not necessarily protection against monetary debasement. Similarly, Benjamin Strong, the chairman of America's Federal Reserve Board in the early 1920s, used inflationary monetary policies under cover of the gold standard, and with the cyclical expansion of the bank credit, fueled an unsustainable boom in the 1920s. The result was a stock market collapse, a banking crisis, the ownership of gold banned for American residents in 1933, and a substantial devaluation of the dollar against gold in January of 1934. Gold then remained exchangeable for dollars, but only for the settlements of overseas trade. Now keep in mind that this happened here, what Benjamin Strong did was after a very successful supply-side recovery from an economic depression essentially that started in 1919. And the policies that were done there were helped to get to the point where we could help get into the 20s as well without having to do these things, without using inflationary and monetary policies. So from these changes, the current monetary situation evolved, driven by a new breed of economists which abandoned classical economics. Classical economics had emphasized the importance of free markets and immutability of Say's law. Instead, the mass unemployment of the 1930s was taken as evidence that free markets and the division of labor had failed, and that the state had an interventionist role to ensure that a depression would never happen again. Despite all the evidence and a priori theory that explains the massive improvements in the human condition that arose from a division of labor and free markets, the denial of Say's law was formalized by Keynes in his general theory, or rather, he skated around the subject, concluding that if, however, this is not the true law relating to the aggregate demand and supply functions, there is a vitally important chapter of economic theory which remains to be written, and without which all discussions concerning the volume of aggregate employment are futile. Note that Keynes does not deny Say's law as his acolytes do. He merely supposes that if it is not the true law. Very interesting and fascinating, I think. From Keynes' supposition, He went on to invent macroeconomics, a mathematically based discipline that substituted human action with aggregates and averages. He studied the temporary budget deficits that are intended to stimulate a slumping economy by monetary inflation, deficits that have now become permanent and increasingly beyond control. Boy, isn't that the case these days, especially. By inventing an economic role for the state, Keynes opened the door for unlimited statist intervention, for the generally non-productive state to become an increasing burden on the productive private sector. With the raison d'etre provided by macroeconomics and questionable government statistics, the reliance by government on inflationary financing has increased over time. We are now at the point where some observers of monetary history warn of hyperinflation. There is a figure that shows the course of the narrow money expansion in dollars in recent years. And boy, since 2010, it has been exponential, and especially heading into the end of the year in 2020, it has gone into hyperdrive for the M1 monetary supply. The annualized rate of increasing in the quantity of narrow money has grown in 3 phases since the end of the 1970s decade of price inflation. Since last January, it has risen to over 50%, not being more than that is only due to further planned inflationary stimulus being delayed by the presidential election. But in the second half of the fiscal year to last September, inflationary financing of the government's budget deficit exceeded tax revenues for the first time. With this evidence, a neutral observer is certain to conclude that monetary debasement of the dollar appears to be out of control. I think that's a pretty safe bet. And having replaced gold as a world's reserve currency, the consequences for all fiat currencies and the global economy of the dollar's looming failure are no less than disastrous. It is hardly surprising that alternative forms of money with restricted increases in circulation are rising in dollar prices. This includes the people's metallic monies, as we know to be gold and silver, to which we can add a new phenomenon, cryptocurrencies, and especially its flagship Bitcoin out there. Having set the scene in the broadest sense, the next task is to explain why there is no escape from further monetary debasement, which might clarify why markets now appear to be discounting it in rising prices for gold, silver, and wider commodities such as copper and also Bitcoin. It's a common misconception among monetarists that the relationship between the quantity of money and its purchasing power is the only determinant of the relationship. There are 2 other important factors involved. The fact that additional money takes time to be absorbed into circulation with consequences, and its purchasing power is also determined by changes in the public's general reference for holding money relative to goods. The temporal shift in the first factor has important effects, in particular transferring wealth from late receivers to early receivers of the additional currency in the Cantillon effect. And when a government agency such as its central bank is the issuer, the ultimate beneficiary is the state at the expense of its people, with important consequences for future inflationary issues. The importance of the second factor can be illustrated by what happens when the general public realizes that all hope of a recovery in money's purchasing power must be abandoned. Irrespective of the quantity in circulation, the public's final rejection of an unbacked state currency will render it useless as a medium of exchange. Very important to consider that. That is the eventual outcome of the unfettered inflation of the money supply. And there are important characteristics of note on the path to the outcome. As really you think about it, these Federal Reserve notes that you see here before you, it is legal tender for all debts, public and private, by the United States of America under the Federal Reserve System. and we have faith in it. It is a fiat note by government decree of which we have faith in. All of us do. You, me, everybody does. And 60% of transactions by foreign nations also have that, and that is what's holding it up. That's what's propping it up. As the quantity of money is increased and its purchasing power declines, the desire for cash and the maintenance of bank deposit balances inevitably declines as well. Initially, the evidence is found in rising prices for assets, both financial and real, and explains why, despite deteriorating economic conditions, equity prices and other assets which are not future claims on fixed quantities of money are rising, measured in depreciating currencies. Until late 2019, these effects were hidden from view by three further influences, two active and one passive. First, large amounts of dollar deposits were absorbed in a carrying trade through the FX swap market, whereby hedge funds borrowed euros and Japanese yen to buy dollars, thereby benefiting from an interest rate arbitrage. This led to a large quantity of dollar bank deposits being tied up by speculators, directly or indirectly preventing their disposal for other financial assets, except through the mechanism of bank credit expansion, and therefore retarding the deposit of the total quantity of deposit dollars for commodities and goods. It was the popularity of this trade which ate up the balance sheet, the capacity of the largest banks. The global systematically important banks and G-SIBs, leading to the bank liquidity crisis that surfaced in the repo market in September of 2019. You heard me refer to that earlier. The second offset to monetary mobility occurred when the Fed reduced its fund rate, removing the reason for the interest rate arbitrage. The dollars freed by that move were partially absorbed by the contraction of bank credit. When interest rates are reduced so that the lender then realizes that he has the inefficient interest compensation to offset against the future value of the loan, he will decline to make that loan. The refusal can be blamed either on an increase in the level of loan risk to the prevailing economic conditions or the lender's realization that the purchasing power of money is bound to decline over time, leading to certain loss. Inflationist economics call this situation deflationary because it works against the desired policy. So the third and passive factor is a large quantity of dollar securities and bank deposits already accumulated by foreigners. And so not only did the accumulation delay the price effects of monetary expansion through import substitution, but the deposit element of about $6 trillion ended up being in firm hands. So yes, that was kind of a save factor there. Now the global economy has entered a slump. The stock of foreign and owned dollar-denominated securities and dollar cash is likely to be reduced because the dollar is over-owned by foreigners for the evolving trading conditions. As noted above, the Chinese have already decided to reduce their preference for the dollars and U.S. Treasury bonds in favor of stockpiling commodities. That the very behavior that more widely leads to a final rush out of fiat currency into goods is not immediately needed. According to the U.S. Treasury's TIC figures, foreigners own an estimated $20.5 trillion in financial securities and a further $6.3 trillion in short-term bills and bank deposits. If other foreigners follow the Chinese in reducing their dollar investments and deposits, it could be catastrophic for the dollar on the foreign exchanges and its purchasing power in the commodity markets. This is something to watch for sure, to see, because it's all based off of faith, folks. It really is. So there's an evolving crisis of dollar balances held by domestic users. With the COVID-19 lockdowns and the damage being done to the economy, especially with another wave of shutdowns by this crazy, coronavirus expansion here, bankers are probably focused more on the elements of risk in an economic crisis than the money's future purchasing power. But at a time when central banks like the Fed are churning out increasingly in quantities of money, the public's use of it has not kept pace with the increased quantity. This is partially illustrated by the contraction of consumer loans and coincided with the helicopter drop of money by the government. Instead of adding to their deposits by borrowing, consumers took the opportunity to reduce some of their debts to lower their cash and credit balances. And so, yeah, they really didn't want that to happen, it sounds like. So the effects of hedge fund speculation and the contraction of bank credit have concealed the general public's reduced preference for money relative to goods. The public is dumping money to acquire all financial assets which are not fixed claims of death. Irrespective of the fundamental factors faced by corporations, and their share prices continue to rise, principally driven by a reluctance to hold money, with the exception of the seller's proceeds being absorbed by the contraction of bank credit. The proceeds of an asset sale end up being reinvested in other assets. So it is crazy what's going on in that realm against the background of changing public perception of the value of retaining cash balances, that the Fed continues to inject more currency into the economy. So whoever is president intends to be part of the stimulus for a further helicopter drop. And the cash is bound to either be used to chase goods not being produced in quantities that match the new money, or to pay down debt. So there's further consequences to the dollar's debasement. If the process of monetary debasement leads to further rejections of cash and deposit money, it will become increasingly reflected in the dollar's loss of purchasing power measured in prices of everyday goods, so much so that the result will become greater than the additional quantities of the dollar suggests is warranted. It was this effect that led to the shortage of notes in cash-based economies, which have suffered an inflationary destruction of money. It prompted the issuing authorities to accelerate their note production. The contemporary position is different. The U.S. and other westernized economies have reduced the use of cash, many with the intention of banishing it altogether. Consumers today use debit and credit cards, which removes the necessity of obtaining physical cash notes to spend. Therefore, the deposit of deposit balances, or the disposal of deposit balances as an inflation crisis, is instantaneous. It does not immediately discourage the monetary authorities from attempting to stimulate consumer spending. As we have seen, money has been fed directly into consumers' bank accounts. How many of you had direct deposit of these relief from the CARES Act? I did. Once the presidential election hiatus in America is resolved, it is anticipated that there will be a further helicopter money drop. With the economy tanking, the neo-Keynesians remain wedded to the idea that the economy lacks sufficient demand. For them, there can be no turning back from inflationary policies, and the destruction of the dollar's purchasing power then becomes a certainty. The debasement of a currency transfers wealth from producers and consumers to the government. It is a process that impoverishes the private sector instead of stimulating it into some vision of wealthless recovery. Not only does the naivete of neo-Keynesian macroeconomists guarantee there will be no let-up in the pace of monetary inflation, but the progressive impoverishment of ordinary people will require a further acceleration of the inflationary process for a given transfer of real wealth. It's a never-ending cycle, it seems. The suppression of interest rates seals the Faustian deal by discouraging lenders from providing loans at rates that fail to compensate them for future value of their capital. Problem that is only compounded by increasing perceptions of counterparty risk. So there it is. It's crazy how this is being done, and so it is being sped up. And if you look back through history, we can see where it has occurred in Germany and in Zimbabwe and other places. And if we keep going the rate we're going, even though the dollar is a world reserve currency right now, but with China and other nations using less of it and spending instead moving towards commodities, we could see it accelerating. But you know what? Something that does have a track record of history of value are what some would be considered as some of those commodities, and that is real money, gold and silver. So you hold on to gold and silver, and you don't have to worry about any of this stuff during the long term. We will still see periods where gold and silver will go down in price, and more than likely that will happen right after you buy it. But you know what? You can't look at this through short lenses. You've got to look at it in the long term. But that long term is getting shorter and shorter because of what they're doing to the dollar with everything that we've described here. I encourage you to press on. This is a time that where it is incumbent upon us to look at these alternative monetary systems out there. And yes, the cryptocurrencies may be part of it as well. And more than likely, the technology behind cryptocurrencies, blockchain or hashgraph or whatever kind of ledger system, it's going to be what's going to be used in the new digital dollar. They're talking about that openly now. But you know what? A lot of that stuff can be tracked. And it may be secure, but it's secure because it can be tracked. And this is why I'm encouraging myself and others to accumulate more of this stuff, as that is real money, has been tested time and time again as such. Gold and silver. The future of money is the past, and we will continue to press on and accumulate this money, to hold it, and when we need it, we can do it. Because it really is logical for gold and silver to be money, because they are. I'd like to extend a multitude of gratitude to you all for taking the time to watch this video, and encourage you to please rate, share, comment, and subscribe.